Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is October 8th at noon, and we're joined by Adam Collins of Movement Capital. Adam joins us every Monday to discuss the latest COT report, market seasonality. Adam is really talented, runs many different websites. He runs freecotdata.com, Movement Capital, simplestockmodels.com, commodityseasonality.com, among many other things. Adam, how are you doing today?
I am doing pretty good. I am happy to be here. So let's get started. Right off the bat, none of this should be construed as investment advice. So don't treat it as such. But for any new listeners, main thing I talk about is COT data, and it looks at how people are positioned in the futures markets. And like, here's an example COT report. So you've got, and this is for corn. A while back, you got different trader categories here, like producers, users, money managers, etc. Then you got a snapshot. How many contracts are they long? Are they short? And obviously, you can't really deduce much from a single report in isolation because you don't know if a given category is super long or not relative to the past. So all I do to it is create a 5-year percentile. And this is an example with 10-year treasury futures. So you've got sort of the different categories here, like asset managers, leverage fund managers, other reportables, non-reportables. And all you do is for me to create for like the composite, spec positioning, I just add up the longs, add up the shorts, net it out. But then I do some other things that I think are quite, useful when you're analyzing positioning. So you can't just look at sort of a net nominal number, like, net 140,000 contracts or something. You need to scale it based on the size of the market, because if a market grows, if open interest increases, sort of this number gets skewed, and vice versa if open interest sort of trends down over time. So anyways, I just literally divide the net spec position, and for other categories, divide that by the open interest. Now you got, net positioning as a percentage of the market. And then to know whether it's high or low relative to the past, I just make a percentile. And that just ranges from 0 to 100%. And basically, if it's 100%, it means that trader category is more bullish or more net long than they've ever been over the past 5 years. And if it's 0%, it means that they are, super bearish on a given contract. And so that's what I do in short for COT. And the way the site is oriented is you got all these different contracts, you got all these different metrics I was talking about, like a 5-year percentile for producers and users, a 5-year percentile for speculators. But the main page of the website that I stick with is the dashboard. And by the way, all the data is fresh as of the most recent report. I just haven't changed the text headers yet. Anyway, so here's what this shows. These are different categories. We got speculators in commodity futures. We got speculators in financial futures, hedgers in commodities, and then dealers in financials. So with speculators in commodity futures, here's sort of an aggregate view of their positioning. This is stuff they're long. This is stuff they're really short. So on the left-hand side, this is definitely probably the most change has happened in that RBOB and HENUL are extremely crowded spec long commodity trades. RBOB more so. And on the right-hand side, you've got the usual suspects in terms of precious metals, soft commodities. They've been there for a while. And one main thing that I always talk about with position is, somebody might look at this chart and say, oh, wait a second, everybody's long RBOB right now, so I'm going to fade that. And they go out, they short RBOB. But so put yourself in the mind or the position of, a fund manager or a trader that's long RBOB. They are not under a ton of heat right now. They're not under a lot of pain. And so there's a low catalyst or incentive for them to sort of suddenly liquidate their position. But if you enter a situation of where, let's say RBOB gap down 5% tomorrow or something, that is sort of like it's a catalyst for change. It is incentive for those people who are sort of crowded on one side of the trade to start to reduce risk. And so it's sort of it's a dual thing you got to pay attention to. What is positioning? And honestly, 90% of the time, positioning is not extreme. And all of these contracts in the middle, all this says to me is, hey, positioning is sort of a wash. It's in the middle of its historical range. That's why I always look at sort of stuff greater than 90% or less than 10%. So you got to sort of note extreme positioning, but then take it to the next level and say, hey, is price action either agreeing or disagreeing with them? You want to identify when it's disagreeing with them. So that's sort of how speculators are positioned in commodities. Let's turn to financials. So on the right-hand side, We've got sort of like what hasn't changed is that the Kiwi dollar is a very crowded short FX trade. But what's new is that the Aussie dollar and the yen, speculators have significantly increased their net short exposure in those two currencies. And with all three, it's sort of, all synonymous that those people are betting on, weaker foreign currencies, stronger US dollar. So it's sort of, tied at the hip. And then we can zoom in on some individual charts. Like, for example, the RBOB chart is right. Let's see. RBOB. Where is it at? Right here. Okay. So we can see the history of positioning. So the white line is spec positioning in this contract. We can see how it's changed over time. And in fact, sort of the three most recent times of when traders have been on the other side of the trade, very short RBOB, it's been late 2015, sort of, late summer 2016, and then here in 2017. These are all sample sizes of, 3. But those were all times that sort of preceded some RBOB strength, which went opposite of how people were positioned. And so we're in the complete, different camp right now where RBOB's a very consensus long position. So maybe that's worth noting. And not only that, but if you look at how producers are positioned, they haven't been this net short in, looks like 4 years. And so that's a sort of a double whammy. We can also zoom in on, because I know, gold's quite popular. We can look at, here's gold position. Same story, different week, same story. Specs, they're not extremely short gold. It's just that it's sort of uncommon for them to be running a net short position, which they are right now. But yeah, so that positioning has not changed. And honestly, the price of gold really hasn't either. So there's nothing really new on that front. We can dive into some of the currency stuff I talked about. So like I said, Kiwi dollar, not new. And in fact, this is sort of a testament to back in July, Kiwi dollar, that was for the first time it got to be a crowded spec short. It's done nothing but go down since. And that shouldn't shock anyone, and that, most negative or positive trends tend to persist. But like I said, it's key to identify when the trend changes and position still extreme. But let's look at some of the currencies where position has gotten, more net short. So like here's the yen. We're getting close to, 4 to 5 year lows in spec positioning in yen futures. And that these past two times, be it December 2016 or November 2017, both those times preceded a, like a mid-single digit pop in the yen against the USD. And then we got Aussie dollar, similar story to the yen. Aussie dollar is going to be just more and more of a crowded spec short. And then we can talk about stock positioning too. So the one that's changed the most in stock futures is probably the Dow. Now, I will say this. All these stock index futures, the E-mini S&P, by far the most liquid. The Dow, NASDAQ, much less so. That being said, traders have definitely ramped up long exposure to the Dow contract. And it's also important to note, all COT data, it covers positioning as of the last Tuesday's close. So this does not cover recent volatility. And I would fully expect that with the new COT report, you probably have, less spec, bullish enthusiasm for the Dow. But we can zoom through. So we got like, NASDAQ, which is constantly surprised me in that traders have not been crazily optimistic on NASDAQ futures, which is, nuts to me. We got Japanese stocks, which is, I think it was like a week or two ago, it was like Japanese stocks at a 27-year high. And spec positioning is definitely along for the ride. They're very net long. We've got S&P, so that's been ramping up. It's not extreme, but we're definitely outside of late January, we're sort of near year-to-date highs in spec position in the S&P. And then VIX. VIX is basically going into the most recent VIX pop. Traders were really short. And in fact, I mentioned this in the last one. I still think it's sort of interesting, is that before the most recent VIX pop, traders were more net short VIX futures than they actually were in late January, which is not what I would expect if you were to ask me about that. That's sort of an overview of positioning. I'll quickly turn to seasonality. And so this isn't looking at how people are positioned. This is just looking at like the seasonal trends in different markets for given months of the year. And so let's look at October. So what has historically done well in October? Honestly, some of the less liquid stuff like, orange juice, oats, soybeans, corn, soybean meal. So that's all like agricultural commodities. And then on the right-hand side of contracts that have historically fallen in October, by the way, this metric is just a 20-year average monthly performance. So what's done poorly has been heating oil, RBOB, nat gas, and then cocoa. So that's sort of energy dominated. Then we've got a snapshot of term structure. We got backwardation popping out in oats, and then wheat, corn, coffee with a steep contango. That means if you're long, it's going to cost you to roll that. Momentum is, a story of energies and commodity futures. I mean, crude, heating oil, they've ripped over the past 12 months. And then on the flip side, soft commodities have done poorly. We can zoom into, what did I say in fact, because I talked about RBOB and positioning, I'll look at RBOB. Actually, I don't have the RBOB seasonality chart, but heating oil suffice. They're quite related. So here's a view of heating oil seasonality in Q4. It is not good. October, November, December, historically weak, and it's not just isolated heating oil, it's also in WTI. And so that's sort of a double whammy of you've got over here, very crowded spec long positioning RBOB right at a time of year when it is historically weak. And so that's interesting. We got 30-year bond seasonality. October is proving to be a weak month for the 30-year as it historically has been. October's typically been the worst month of the year for 30-year treasuries. And while we're only a couple days in, hasn't been a good month for bonds. Then we got some other stuff. We got S&P seasonals. Everybody writes about it, so it's not really new. But yeah, Q4 is typically quite strong for the S&P. Grains. Not much here other than, like I said, October is, like if you look across a couple of these contracts, October typically ranks pretty high for being like a high performing month. Like here's corn. We got metals. Metals don't really have like these persistent seasonal trends in Q4. It's sort of a chop fest, except for palladium. Palladium's so strange in that it stands out in that Q4 is quite strong. And in fact, palladium, it's the only precious metal that's actually held a bid over the past month or two. It was down 20% in August year to date. It's retraced all of it. Palladium's been extremely strong. You probably should keep an eye on the fact that backwardation's blown out a bit. Okay, so like I said, precious metals, not much seasonality in Q4, but you got to keep in mind if you're trading precious metals, January, February, and not just precious metals, but copper too. January and February have historically been very strong. And so I don't care if it's, gold, palladium, platinum. And in fact, it happened in 2018. You had the typical Jan and Feb strength, and then the entire, BM complex just faded the rest of the year. And then we've got some stuff on soft commodities. The only one that stands out in soft commodities is that cocoa has historically had its, worst month of the year in October. And so that is, it's timely info. But overall, summary of everything I ran through. When it comes to positioning, we got energy futures are really crowded spec longs. We got precious metals and soft commodities as very crowded spec shorts. When it comes to like FX positioning, the three sort of extreme crowded spec shorts are Aussie dollar, yen against the USD, and then the Kiwi dollar. And then a takeaway for seasonality is that October is historically strong for agriculturals and historically weak for energy futures. So I hope that was useful. If you got any questions, feel free to let me know.
Thanks, Adam. So it's interesting. Somebody's actually asking to follow up on Kiwi, and he's saying, he's noting that for the past 2 months or so, basically, Kiwi has been oversold. And as you said, that's an example of, why not to fade necessarily purely just on the data. But I guess the question is, when would you look to take the other side on these markets that have been oversold for days, weeks, months? Like Kiwi as an example, it's been at least 2 months where it's been heavily in that red percentile.
Yeah. So here's how I think about it. I don't like the term oversold because I don't know, markets remain overbought and oversold more frequently than they don't. But if we're sort of getting to the point of, okay, positioning has been extreme for a long period of time, when do you think it's most actionable? The answer to that lies in your time horizon. So for example, let's say you carry positions for a couple weeks, couple months. If Kiwi dollar pops 2%, that is not a super big jump relative to your time horizon. And it's probably not going to put crowded spec shorts under a lot of pressure. And so that's probably too weak of a signal given your time horizon. But if you're solely trading intraday and let's say Kiwi dollar, ramps 1.5% tomorrow, then on a shorter time scale, that could totally, trigger some more short covering in the short term. And so I would say that the magnitude of the price move to make crowded positioning sort of more actionable as like, this like exit scenario, it's a function of your time scale. And yeah, and I would say this, always I would sort of steer towards a bigger move than you think, because it takes big moves to shake out these people who've been entrenched in these trends for months and months at a time. And so it's not a thing of where, if the New Zealand dollar rises 50 bips against the USD, that's not going to dissuade any, spec shorts from pulling due to risk. So I hope that answered the question.
But is there any sort of signal that goes along with the percentile and the kind of when you get something that's a high signal, let's say like gold or Kiwi's been oversold for a long time, is there any accompanying sort of technical signal or anything that you kind of look for that kind of triggers the, okay, well, the market's heavily short, this signal's now confirming there might be a reversal, this means that, X and Y, this might be a good time to look for sort of unwinds?
Yeah, I mean, I personally, I don't have a favorite, but I think that sort of that defaults to like somebody's technical framework. So there's lots of ways to slice it. You could apply like a simple CTA overlay, like a moving average or something like that, or you could use like Mark Fisher's ACD as it, because he tracks the 30-day number line, and to be honest with you, that could be sort of an interesting cross analysis. Is okay. Let's say, for those that don't know, the 30-day number line is sort of an indication of strength or weakness in a security. And so let's say that you had like super crowded positioning in Kiwi dollar, right? And let's say it stayed like that. But let's say that 30-day number line started becoming less negative. Let's say it flipped positive. That could be a combo of a more actionable signal than positioning alone. But what I'm getting at is there's a million ways to slice it. You could use something like ACD. You could use a simple moving average. You could use an increase in volatility, but you just pair it with something that's sort of like a high quality technical signal that is not super sensitive to small changes, because what you're interested in isolating is a larger trend change.
Right. What about taking a look at the VIX? It's obviously been a very big mover over the past few days. It got up to as high as 1838. And I know that you were talking about it last week and the week before, that the position was almost getting back to the February levels in terms of the short sort of position.
Yeah. I mean, it was a lot more, which is the crazy part. So like going into late January, early February, I think the net spec position in VIX futures was like net short, I don't know. I know that it was less than $1 billion. What I'm getting at is now, or as of last Tuesday, it was more than that. And so, because it's crazy that this sort of narrative of short balls a crowded trade, that was definitely a more popular narrative back then. And then now we have a situation of where the short ball trade is even more crowded. But I honestly haven't read that much about it, because it's sort of like, February happened, one of the ETFs sort of went away. It's like, we dealt with that issue. And from a positioning point of view, I wouldn't consider that to be the case, simply because they're going into late last week, there was a lot of money short VIX futures, and obviously that was to their detriment. And I think another thing to pay attention to with VIX is this is solely looking at VIX futures. You can make the argument that there are a lot of other sort of like implicitly short volatility strategies, be it like people who chronically sell 5% out of the money puts or stuff like that. And so it's sort of a tough exercise to like put a total dollar figure on like the entire short vol complex. But all I can speak to is VIX futures in isolation, and I can say that currently speculators are more net short those than they were earlier this year, which was
hey Adam, it's Larry. How you doing?
Yeah.
I wanted to ask a question and sort of add to that. I think you really can't get that good a read, because the bottom line is it could be people want to lean short VIX because a lot of these products are flawed and they're not a tracking vehicle, and what they do is they'll buy index against selling that. I know numbers of strategies that do that. So granted, you're seeing that, but you're not really, that's a harder one to take away. because there's so many strategies out there that could be long, just indices or whatever, and the inefficiency of these vol products to track right is really what people are trying to take advantage of. So the fact that they don't track well, especially these double and triple ETFs, it's a problem because they're inherently losing 2 clicks a day or 3 or 5 depending on their tracking. And a lot of these vol strategies, they're more rolling, so they're not, they're starting to get in VIX the last 2 or 3 days where they were out of it 100%. So anyway, I get it, but I think maybe those numbers, I hope they're right, because that would be really great for trading, but I'm not as convinced, because if somebody wants to be long vol, they can buy the 2 week out at the money put and get on as much long vol as they want with gamma. So anyway, that's just my perspective on it. It's a harder takeaway than a lot of the other indexes.
Yeah, no, for sure. And on that topic of volatility, if anybody's interested in sort of volatility trading, they need to check out the PDF from a guy named Christopher Cole at Artemis Capital. He writes extensively about vol trading. It's all free. It's all very interesting stuff. And where he sort of focuses is, it's one thing to be directly short the VIX or to buy one of these short vol ETFs, whatever. It's another thing of there's lots of strategies out there that are sort of short vol in nature. And he sort of crafts the argument that, in a year in which buybacks have been so popular, all this repatriated money, when you've got a ton of corporate buybacks, that sort of inherently adds sort of a short vol color to the market, because there's sort of this, programmatic, they step in, they buy. And if you enter a world in which buybacks dissipate, that it's sort of, you could craft the argument that that's going to lead to a more volatile environment, just because it's less of sort of, less of a volatility dampening mechanism. And so anyways, that's way outside my domain, but he writes some smart stuff if people are interested.
No, I'm going to definitely check it out. But, it's funny to me, like, people are freaking out about the market, and we're literally 2% from an all-time high.
Yeah.
Freaking out. They're about to freak out. So I don't know what's going to happen. How could they live through Europe? I mean, Europe is down, DAX is down 20% basically, almost off its high, down over 10% for the year. And, Hang Seng's down 20. So anyway, I'll let you do your thing. I just I wanted to chime in on that just because I thought it would be interesting, to discuss that, because we're very cued in on the volatility, and I deal in a lot of these products that are flawed, and a lot of people are selling the flawed products, and then around that they're doing a lot of different things. So it'd be interesting to see how everything sort of settles out.
Yeah, for sure. Well, Mike, is that it for the questions?
Yeah. Thanks a lot. That was a lot of great information. We really appreciate you joining us, giving us that
awesome.
insight.
Thanks.
Yeah, no worries. Happy to do it.
That's Adam Collins of Movement Capital. Thank you very much. We'll talk to you next week.
Thanks, Adam.
Alrighty. Yeah.